Imagine having like the absolute busiest 3 month in your company's entire history. You know, you have lines wrapping around the building. Your app is practically melting down from just the sheer volume of digital orders coming in.
Oh yeah, total operational bottleneck.
Exactly. And you rake in this staggering $3.3 billion in just 90 days. But, and here's the crazy part, at the exact same time, after the dust settles, you realize you haven't made a single penny more in profit than you did a year ago.
Right, which just feels impossible.
It does. The math just doesn't seem to math. And that is exactly the puzzle we are looking at today. Welcome to a special Talk Tickers edition of The Deep Dive.
Glad to be here.
So our mission today is extremely focused. We are breaking down Chipotle's Q2 2026 earnings call ticker symbol CMG specifically for you, the retail investor. We usually try to keep these under 5 minutes, but there's just so much to unpack here that we're going full deep dive today.
Yeah, we have to really get into the weeds on this one.
We do. We are going to translate all that dense Wall Street jargon into plain English, give you an unfiltered, opinionated take on the actual results, and tell you exactly what this means for your portfolio.
Absolutely.
We have the official Q2 2026 earnings call transcript featuring their CEO and CFO right here in front of us. And I mean, the divergence in these numbers is completely wild.
It really is like the ultimate retail investor puzzle right now.
Yeah.
You see the top line going straight up. The physical stores look incredibly busy. The brand seems as, culturally relevant as ever.
Oh, totally.
But for some reason, the actual profit isn't flowing through to the bottom line for the shareholders.
Yeah.
So to respect your time, we are going to be methodical. We are looking at the headline numbers, the specific story driving those numbers, what management is projecting for the future, and finally, our definitive, actionable verdict on whether this stock is a buy, hold, or sell right now.
All right, let's jump right into it. I'm looking at the top line for this quarter, and it is roaring. I mean, revenue is up 9.3% to $3.3 billion.
Right, a huge number.
Massive. That is a massive amount of cash moving through their physical and digital systems. But when I look at the bottom line, it's like they hit a brick wall.
Yeah, they really did.
How on earth can a business grow its revenue by nearly 10%, move that much product, and yet their earnings per share literally does not move a single inch?
Well, it comes down to what Wall Street calls margin compression.
Margin compression, okay.
Yeah. Specifically, their adjusted diluted earnings per share, or EPS, came in at 33 cents. As you pointed out, that is completely flat compared to the exact same quarter last year.
Wow.
Zero growth in EPS despite a 9.3% jump in total revenue. And the reason why is that their restaurant level margins took a very serious hit. They were down 220 basis points, dropping to 25.2%.
Okay, let's translate that right away for someone who might not spend their entire day, staring at Bloomberg terminals. When you say 220 basis points, what does that actually mean in the real world of a restaurant operating environment?
So a basis point is just 100 hundredth of a percent. Yeah. So 220 basis points means 2.2%. In the restaurant industry, where margins are traditionally razor thin anyway, a 2.2% drop in profitability at the restaurant level is a massive swing.
I mean, it sounds small to regular people, but that's huge.
Exactly. Now, to be fair, a 25.2% restaurant level margin is still incredibly strong compared to the rest of the fast casual industry.
Right, because I know a lot of traditional fast food places operate in like the mid-teens.
Yeah, mid-teens is very standard. But for a premium, highly optimized operator like Chipotle, a 220 basis point contraction is a major red flag for institutional investors. You have this immense top-line strength colliding directly with bottom-line stagnation.
So if revenue is up nearly 10%, but profits are flat, that money didn't just vanish into thin air. It bled out somewhere in the back of the house.
Right, it had to go somewhere.
Exactly. So what exactly is draining the cash? But before we get into the expense side, we really need to understand where that $3.3 billion actually came from. Because it wasn't just them hiking prices on burritos to fake top-line growth, right?
Right, and this is where we have to highlight arguably the most important metric in the entire first half of this earnings call. Their comparable restaurant sales, what the industry calls comps, increased 2.2%.
Okay, comps.
Yeah. Comps just measure the sales growth of stores that have been open for at least a year, so it filters out the artificial growth of just, slapping up a bunch of new stores.
Right. It's a true apples-to-apples comparison.
Exactly. But the critical layer underneath that 2.2% comp growth is that it was driven by a 1% increase in actual foot traffic.
Actual human beings walking through the door or submitting an order on their phone?
Yes.
A 1% increase in physical transactions. On the surface, 1% sounds tiny. It sounds like a rounding error. Why why is a 1% traffic increase the most important number in the call?
Because you have to look at the macroeconomic environment we are living in right now in 2026.
Which is pretty rough.
It's highly cautious. It's a heavily pressured consumer environment. Inflation has battered discretionary income for years now. When you look at the broader restaurant industry, almost everyone is seeing foot traffic declines.
Right. People are just staying home.
Yeah, major traditional fast food chains are posting negative traffic numbers because consumers are finally balking at the prices of combo meals and pulling back on eating out altogether. The pie is shrinking.
So if the overall restaurant industry is losing foot traffic, but Chipotle is gaining 1% more physical transactions, that means they aren't just growing in a vacuum.
No, not at all.
They are actively stealing customers away from other restaurants.
Precisely. They are actively stealing market share. It means their value proposition, which their CEO emphasized heavily on the call, is actually resonating in a very difficult economy.
Makes sense.
When a consumer is choosing where to spend their, very limited dining out budget, they are increasingly choosing this premium fast casual option over traditional fast food, likely because the price gap between the two has narrowed so significantly in recent years.
Yeah, a burger meal is like $15 now anyway. And it's not just people walking in the physical doors and standing in line either. Their digital sales are an absolute juggernaut.
Well, completely.
I mean, they reached $1.3 billion in digital sales just in this quarter alone, which now makes up 38.3% of their total sales.
Really?
Yeah, that's up from 35.5% last year. So the top line is incredibly healthy. They are stealing market share. Their digital flywheel is spinning faster than ever. And yet we go back to that 220 basis point margin drop.
Right.
The extra money is coming in, but it is leaking out before it reaches the shareholders. So let's, follow the money. Where exactly did it go?
Well, it's not just one single leak. It is a convergence of several inflationary pressures hitting the business model all at once.
Okay.
Let's break down the specific drivers of this margin squeeze, line item by line item. First, their cost of sales rose to 29.7% of total revenue. That is about an 80 basis point jump from last year.
Cost of sales meaning the literal physical goods required to make the product, right? The food and the packaging.
Exactly. According to the CFO, this 80 basis point jump was driven primarily by inflation in beef and freight.
Freight.
Yeah, freight is a huge, often overlooked component. It costs money to move millions of pounds of fresh food across the country in temperature-controlled trucks.
Oh, for sure.
When diesel prices or transportation labor costs go up, that hits the restaurant's P&L directly. But they also cited another very specific reason for the cost of sales jumping, and this one is super interesting.
What was it?
Increased usage of ingredients like chicken, steak, and produce.
Okay, stop right there. Increased usage is a very diplomatic Wall Street phrase.
It really is.
Does that essentially mean they're being more generous with their portion sizes? Because we have all seen the social media trends over the last year where customers were literally filming workers to pressure them into adding more chicken to the bowl.
Yeah, the phone in the face trend.
Exactly. Is management quietly admitting here that the social media pressure actually worked and they are serving larger portions, which is eating into their margins?
That is the widespread interpretation, yes.
Wow.
When a management team cites increased usage as a headwind against margins, it means the theoretical yield of a case of chicken isn't matching the actual yield being served over the counter.
Right.
They are either intentionally increasing portion sizes to protect brand loyalty and combat that negative social media sentiment, or they're experiencing a slight dip in inventory control efficiency at the line level.
Which is basically the same thing in practice.
Exactly. Either way, they are putting more expensive protein into the bowls, and they are eating the cost of that rather than passing it immediately to the consumer.
And I imagine they had some relief in other areas of the supply chain. I mean, food costs rarely inflate perfectly evenly across the board.
Yeah, they did. They saw some relief from lower avocado and dairy prices during the quarter, which definitely helped soften the blow. But ultimately, it was just not enough to offset the sheer cost of moving the goods via freight and the macro inflation on the beef itself.
So food costs are up. Let's move to the second major bucket of expenses, the people serving the food.
Right, labor.
Labor costs rose to 25% of sales. That is a 30 basis point increase year over year.
Labor is always a massive focal point for any quick service restaurant.
Always.
The management team cited standard wage inflation and performance bonuses as the primary drivers of this 30 basis point increase.
But they also specifically mentioned something else on the call. They talked about investing in, and I quote, labor execution in restaurants as we lean into the guest experience.
Yeah.
I want to pause on that because it sounds very corporate. It sounds like exactly what a CEO says to sound benevolent.
Right, PR speak.
Exactly. And then you have operating costs hitting 14.9%, which is a 90 basis point jump, driven by higher marketing, insurance, maintenance, and utility costs. So literally every single line item, the food, the labor, and the operations, cost more to execute this quarter.
Which perfectly explains the EPS stagnation. You are bringing in 9.3% more cash, but it costs you significantly more to buy the beef, pay the staff, run the marketing, and just keep the lights on.
Yeah.
But I want to go back to what you just highlighted regarding labor, because that piece, the leaning into the guest experience, is where this earnings call gets truly strategic.
Okay, I'm listening.
It is tied directly to a massive operational overhaul they're in the middle of rolling out called HEAP.
Yes, the high efficiency equipment package, HEAP. This feels like the absolute beating heart of their future operations. Let's really dig into this because as a retail investor, understanding how a company physically makes its product is usually where you find the long-term alpha.
Absolutely.
So what exactly is this equipment package doing on the ground inside these restaurants?
Well, it is essentially a complete re-engineering of the back-of-house food preparation process.
Okay.
The exact mechanical details involve automated cutting tools, more efficient cooking surfaces, and reorganized prep stations.
Yeah.
The management team noted that HEAP makes food preparation significantly more efficient and much more consistent across different locations. But the critical data point they delivered, like the number that investors really need to circle in red ink, is that stores with HEAP installed are outperforming the rest of the company by cranking out 2 to 3 extra entrees per 15-minute peak period.
Let's do the math on that because it sounds small, but in this industry, it is massive.
It's huge.
A 15-minute peak period, or what the industry calls the max 15, is like the holy grail metric for any fast casual operator.
Right.
If you have a line out the door at 12:15 p.m. on a Tuesday, your revenue is entirely bottlenecked by one single factor: how fast your human crew can physically assemble a burrito and ring it up.
Yep, the physical speed of the line.
Exactly. So if HEAP allows a crew to push 2 to 3 extra entrees in that tiny hyper-compressed 15-minute window, how does that compound over time?
Well, let's look at the baseline first. The CFO mentioned that in their standard stores without HEAP, they are doing somewhere in the low 20s for in-store entrees per 15 minutes. At the same time, their digital make line in the back is doing mid-teens. So if you combine them, a standard store is pushing out low to mid-30s in total entrees during their absolute max 15 throughput.
Gotcha.
Adding 2 to 3 extra entrees on top of a base of, say, 33 is nearly a 10% increase in peak efficiency.
10% more product sold during the only hours of the day where demand vastly exceeds supply, because nobody is lined up out the door at 3:00 p.m.
Exactly. The dead zones don't matter.
Right. The entire business model relies on maximizing the lunch rush and the dinner rush.
Exactly. If you capture 3 extra sales every 15 minutes during a 2-hour lunch rush, that is 24 extra entrees. Do that again at dinner, that's almost 50 extra entrees a day.
Wow.
Multiply that by 365 days a year, and you are talking about tens of thousands of dollars of pure incremental revenue per store, simply because the back-of-house prep was more efficient.
That's incredible.
It translates directly to hundreds of basis points of improvement in comparable sales for those specific HEAP-enabled stores. And they currently have this installed in 1,000 stores, aiming for 2,000 by the end of this year.
But here is where it gets incredibly contentious and where I imagine a lot of institutional Wall Street analysts are getting very frustrated.
Absolutely.
When a company installs hyper-efficient new equipment, the traditional Wall Street playbook is ruthless and simple, right? It's like, great, this new machine saves us 3 hours of prep labor a day. Cut 3 hours off the payroll, reduce your headcount, and let that saved cash drop straight to the bottom line to boost our margins.
That's standard operating procedure.
But Chipotle isn't doing that, are they?
No, they are not. Instead of pocketing the labor efficiency created by HEAP in the morning, management is actively reinvesting those saved labor hours back into the frontline crew during the peak rushes.
Okay, I have to push back on this because I am highly skeptical.
Fair enough.
Isn't that just a very convenient excuse for Wall Street, saying, we are reinvesting in the guest experience? Sounds a whole lot like PR spin for, Our expensive new machines didn't actually save us any net money on payroll, so we need a nice way to frame the fact that our labor costs still went up 30 basis points.
Right, sounds like covering their tracks.
Exactly. Why should an investor believe this is a strategic reinvestment and not just a failure to control costs?
It is entirely fair to be skeptical, but if we break down the mechanics of how a burrito assembly line actually functions, it is a brilliant deployment of resources.
Okay, explain it to me.
Think of the employee rolling your burrito as a computer's central processing unit, the CPU.
Okay, CPU.
In the old system, the CPU had to constantly stop rendering the final product to go fetch more memory. Like they had to stop rolling, turn around, grab a fresh pan of chicken, swap out the empty salsa container, wash their hands, and then get back to assembling.
Which just kills the momentum.
Exactly. Every time they turn around, throughput halts.
The line stops moving.
Exactly. What management is doing with these saved labor hours is deploying what they call linebackers and expo roles.
Linebackers.
Like football.
Yeah. So the expo is the person exclusively bagging the food and handling the payment transaction, getting the customer out the door. The linebacker acts like your computer's RAM. They fetch the data in the background.
Ah, I like that analogy.
Right. The linebacker is a flex player who constantly monitors the line, restocks the salsas, grabs the fresh pans of steak, wipes down the counter, and keeps everything fully stocked so that the CPU, the people serving the food, literally never have to turn around or stop assembling.
Oh, wow.
The assembly line never pauses.
So they are taking the hours saved from having to manually chop vegetables in the morning because of the new MAPI machines, and they are using those exact same hours to pay a linebacker to stand behind the counter at 12:30 p.m.
Yes. And management stated that for the first time this quarter, they had linebacker deployment in over 70% of their restaurants.
Okay, the CPU and RAM analogy makes a lot of sense. You are essentially removing the friction from the transaction. Exactly.
But from a shareholder perspective, they are consciously choosing long-term brand health over short-term margin padding. They're letting the line move faster to build customer loyalty rather than cutting staff to juice the quarterly earnings.
Which, as you pointed out, is a very difficult concept to sell to a day trader who only cares about the next 90 days.
Right.
But it is a profoundly beautiful thing to hear if you are a long-term retail holder. By reinvesting efficiency into better customer service, better hospitality, and properly deployed staffing during the absolute busiest times of the day, they are building a structural moat against their competitors.
A structural moat based on speed and reliability.
Precisely. If you know you only have 30 minutes for your lunch break, you are not going to go to a restaurant where the line doesn't move.
No way, I'd go hungry first.
Right. By ensuring the line always moves, Chipotle captures that marginal customer. Management noted a meaningful reduction in refunds and notable year-over-year increases in guest satisfaction scores.
Which is huge.
It is the bedrock foundation of sticky, recurring revenue. The customer trusts the system.
And it seems that trust is tying perfectly into their menu and marketing wins for the quarter, because you can have the fastest line in the world, but you still need a compelling reason for the customer to walk through the door in the first place.
Very true.
And they had some massive hits this quarter. They brought back the Chipotle Honey Chicken, which the CEO noted had a cumulative attachment rate north of 25%.
Think about the scale of that.
It's crazy.
An attachment rate north of 25% means that more than 1 out of every 4 orders across the entire global company included this specific promotional item.
That is an incredibly successful menu innovation.
It really is.
Plus, the new cilantro lime sauce is actively outperforming their traditional red chili and adobo ranch options. But what I find fascinating is who exactly is buying these new items.
Yes, this is a crucial piece of demographic data.
Right.
During the Q&A portion of the earnings call, an analyst specifically asked about the pressure on younger and lower income consumer cohorts.
Because they're the ones hurting the most.
Exactly. Those are the demographics feeling the bite of 2026 inflation the hardest. Their rent is up, their groceries are up, their discretionary income is virtually gone.
Yeah.
You would intuitively think that a premium fast casual brand like Chipotle would lose that lower income guest to traditional, cheaper fast food during a deep economic squeeze.
Right. If you are counting every dollar, you drop down a tier. You go get a value menu burger instead of a premium bowl.
But management confirmed the exact opposite is happening.
Really?
Yeah, it was actually those exact 2 cohorts, the younger demographics and the lower income consumers, that improved the most quarter over quarter for Chipotle.
That is completely counterintuitive. Why is the broke college student or the squeezed lower income worker choosing the more expensive option?
It speaks entirely to the psychology of perceived value.
Okay, unpack that.
If a traditional fast food combo meal, like a burrito, fries, and a drink, has slowly inflated to $11 or $12, the consumer feels ripped off.
Absolutely, it hurts.
They remember when that same meal was $6. But a massive, fresh, customizable bowl from Chipotle might cost $11 or $12 as well.
Right, the gap has closed.
The price gap between low-tier fast food and premium fast casual has almost completely vanished. So the lower-income consumer is making a calculated choice.
Ah, I see.
If they only have $12 to spend on a luxury like eating out, they are going to spend it where the perceived quality, the freshness, and the sheer volume of food is highest. They perceive Chipotle as a high-value indulgence.
And Chipotle is aggressively marketing to that exact sentiment. They had a huge marketing push this quarter with the tatted like a Chipotle bag promotion, which was incredibly viral.
Oh yeah, it was everywhere.
They ran a match day buy one, get one event for the World Cup that management noted became the most successful single-day sales event in the company's entire history.
They're executing at a very high level creatively right now. They recently brought on a new chief brand officer, Fernando Machado, who is known for highly disruptive, culturally relevant campaigns. And they paired him with a new chief digital officer, Arlie Sisson. Sisson is already making massive operational waves by rolling out a tool called Cook to Needs.
I saw this in the notes. This is an AI-driven tool, correct?
Yes.
How does Cook to Needs actually function in the kitchen?
It is an automated demand forecasting system for the grill cook.
Okay.
Historically, the grill cook has to guess how much chicken or steak to drop on the grill based on how busy the line looks and, just historical intuition.
Which sounds like a recipe for disaster.
It can be. If they guess wrong, you either run out of food and the line stops killing your max 15 throughput,
right,
or you cook too much and throw it away at the end of the shift, which kills your food cost margins.
Right.
The Cook to Needs AI analyzes real-time digital order velocity, historical trends, and current line speed to tell the grill cook exactly what to drop and exactly when to drop it.
So they are pulling every possible lever. They have the culinary lever with the honey chicken, the digital lever with the AI forecasting, the marketing lever with the World Cup promos, and the operational lever with the HAP machines and the linebacker.
Right, it's a full court press.
They are building a machine designed to do one thing: drive transaction volumes as high as physically possible.
And this confidence is reflected directly in their capital allocation.
Let's talk about that.
Before we move into their future guidance, we have to talk about how management is treating their own stock. Despite the margin pressure and the flat EPS, they opportunistically repurchased $631 million in stock this quarter at an average price of $32.55.
That's a lot of cash.
And perhaps more importantly, the board of directors just authorized a massive new $1.3 billion buyback program.
For the newer retail investors listening, explain why a stock buyback matters. Why do we care if the company buys its own shares?
Stock buybacks are a primary method of returning capital to shareholders, alongside dividends. When a company buys its own stock on the open market, it retires those shares.
Okay.
This reduces the total number of outstanding shares in existence. Think of the company as a pizza.
Let's stick with the food analogies.
Always. If you reduce the number of slices the pizza is cut into, every remaining slice suddenly becomes slightly larger and represents a greater percentage of the total pie. Your ownership stake mathematically increases without you having to buy a single additional share.
So it artificially boosts earnings per share over time because you are dividing the earnings by fewer shares.
Exactly. But more importantly, it is a massive signaling mechanism.
How so?
When a management team authorizes a new $1.3 billion buyback, while their margins are technically getting squeezed and Wall Street is groaning, they are signaling extreme, undeniable confidence in their long-term cash flow generation.
Right. They're putting their money where their mouth is.
They are telling the market, we believe our current share price is undervalued and we are willing to spend over $1 billion of our own cash to prove it.
It sets a psychological floor under the stock price.
It really does.
Okay, so the operational investments sound fantastic for the long term. The digital flywheel is spinning. They are stealing market share from traditional fast food, and the buybacks provide a nice safety net.
Yeah, it all sounds great.
But as we always say here on Talk Tickers, Wall Street doesn't trade on the past.
Never.
The stock market is a forward-looking forward-looking mechanism. It only cares about what you are going to do tomorrow. And that brings us to the future, specifically management guidance. Because frankly, the crystal ball for the third quarter is looking incredibly cloudy.
It is, and this is where the narrative shifts from celebration to caution.
Uh-oh.
Yeah, management expects Q3 comparable sales to be heavily muted. They are actively guiding for just a positive 1% comp.
Wait, they just posted a 2.2% comp in Q2, driven by a 1% increase in actual foot traffic? Guiding for only 1% total comp growth in Q3 is a very sharp deceleration.
It's a huge drop-off.
Why is the engine suddenly stalling out?
The reason for this sudden deceleration is the most critical piece of nuance in this entire earnings call, and it is something every investor needs to understand. It is what management is calling the cyclospora shadow.
Okay, we need to unpack this very carefully because the words food safety are the absolute third rail for restaurant stocks.
Oh, without a doubt.
A foodborne illness outbreak can destroy a brand overnight, and Chipotle has a very sensitive, highly publicized history with food safety issues from several years ago. So what exactly is going on here?
There's currently an industry-wide foot traffic slowdown tied to a national cyclospora food safety scare.
What is cyclospora?
It's a parasite linked to fresh produce, often things like lettuce or cilantro.
Yikes.
But here is the crucial underline it twice distinction that management desperately wanted to make clear on this call. Chipotle is absolutely 100% not impacted by this outbreak.
They are completely innocent.
Completely. Their lettuce is safely sourced from dedicated farms in California, and they do not even use the specific regional ingredients implicated in the broader industry issue. Their supply chain is entirely clean.
But the consumer doesn't always read the fine print, do they?
Exactly. When the nightly news runs a terrifying segment about foodborne illness related to fresh produce in fast casual environments, there is a massive guilt by association effect.
People just panic.
The average consumer doesn't research corporate supply chains. They just hear sick from lettuce and decide to order a pizza instead of a burrito bowl.
Right.
Management noted on the call that their strong Q2 traffic momentum actually continued right into the first half of July. Everything was looking great.
Okay, so what changed?
In the second half of July, as these national headlines broke, they saw an immediate, sharp softening of about 200 basis points.
That is a 2% drop in total traffic almost overnight.
Yeah.
Directly tied to the panic around the cyclospora issue, even though nobody got sick at a Chipotle.
Precisely. It is the definition of collateral damage.
Yeah.
Because the guy down the street got sick, nobody is walking down the street at all.
That is so rough.
And because it is virtually impossible to predict how long consumer fear will linger in the media cycle, management is taking the highly conservative route.
Which is probably smart.
They are baking that 200 basis point drag into their entire projection for the third quarter,
Right.
which is why the official guidance is only a plus 1% comp. It is a temporary headwind. It is not a structural flaw in their business, but it is real, and it is hitting their daily foot traffic right now as we speak.
Which makes their next strategic move seem incredibly bold, if not a little bit risky.
Oh, the pricing.
Yeah, because at the exact same time that they are losing foot traffic to a national media scare, their own costs are going up again, specifically avocados.
Right, the guac.
Management noted that avocado pricing is moving sequentially higher. Avocados are apparently made of gold this year, and to offset that specific commodity inflation, Chipotle is planning to raise menu prices in the mid 2% range during Q3.
This specific decision raises a massive debate among analysts regarding consumer elasticity.
Let's define that. Elasticity is just a fancy economic term for asking a very simple question. How much can you raise the price of a burrito before the customer finally says no thank you and goes somewhere else?
Right. How far can you stretch the rubber band before it snaps?
Exactly.
Management spent a significant portion of the Q&A explaining that their pricing strategy is highly methodical. They do not just issue a blanket corporate mandate to raise prices by $1 everywhere overnight.
Okay, so how do they do it?
They use a rolling price hike strategy, market by market, region by region, zip code by zip code, rather than hitting the entire country with a massive sticker shock.
But wait, let me make sure I'm hearing this right and tell me if this isn't playing a very dangerous game of chicken with consumer loyalty.
Sure.
They are planning to raise prices again in Q3 by roughly 2.5%, right at the exact same moment that foot traffic is already artificially slowing down by 2% because of industry-wide health fears.
That's the plan.
You have fewer people coming in the door, so your solution is to charge those few people more money. Isn't that how you destroy a brand's value proposition?
It certainly looks precarious on the surface.
Yeah.
and it is a totally valid concern. But the CFO laid out the mathematical reality behind the decision.
Okay, let's hear the math.
In the first half of this year, the company absorbed a massive dislocation in their modeling. Macro inflation was running in the 3% range across their supply chain. But out of caution for the consumer, they only took about 1.6% in menu pricing.
So they held back.
They purposefully absorbed that hit. They ate the difference. And that absorption is exactly why we saw the Q2 margins drop of 220 basis points. The math eventually catches up with you.
You can only play the good guy for so long before the shareholders demand their margins back.
Exactly. Now, moving into Q3, they expect their baseline inflation to remain stubbornly high, still around that 3% mark. So they are finally bringing pricing up to the mid 2% range to catch up.
They're trying to close the gap.
Yes. By the fourth quarter of this year, they expect the gap between their menu pricing and their supply chain inflation to finally close and neutralize.
I see.
So yes, they are playing a game of catch-up, but they believe they are doing it slowly and surgically enough that they can monitor the consumer's resistance at a hyper-local level without snapping that elasticity rubber band.
They test the waters. If a specific market rejects the price hike and traffic plummets, they can pull back.
Exactly. It's highly surgical.
And while all of this granular margin-level drama is playing out here in North America, the price hikes, the labor debates, the food safety scares, the company is simultaneously executing an incredibly aggressive physical expansion that almost defies logic.
This expansion is the underlying, unstoppable engine of the entire company.
It's wild.
It really is what separates them from almost every other brand in the market. Despite all the macroeconomic noise, they reaffirm their guidance to open 350 brand new restaurants this year alone.
I want the listener to really internalize that number. 350 new restaurants in 12 months.
It's almost one a day.
It is. That is nearly one brand new, fully staffed, fully operational restaurant opening every single day of the year. The scale of that logistics operation is staggering.
It gets even better. Of those 350 new builds, management stated that 80% of them will include a Chipotle.
The digital order drive-through pickup window.
Correct. The Chipotle is arguably the greatest real estate innovation in the company's history.
Why is that? I mean, it's just a drive-through, right?
No, because these are not traditional drive-thrus where you pull up and yell your order into a speaker.
Oh, right. You have to use the app.
You must order ahead on the app. You simply pull up, scan, grab your bag, and drive away. We know from years of historical data that stores equipped with a Chipotle carry significantly higher margins because they require less front-of-house labor.
Because nobody's taking the order manually.
Right, and they carry vastly higher digital attachment rates, which breeds extreme customer loyalty.
And they aren't just blanketing the American suburbs either. They are pushing globally in a very aggressive way.
Very aggressive.
The CEO mentioned on the call that he had just returned from attending an opening in Monterrey, Mexico, working with the local partner, Alcia. They are launching in Seoul, South Korea, with the SPC group later this year.
Yeah.
They successfully opened in Abu Dhabi in April. They opened in Qatar just last week. And Saudi Arabia is slated next. They are planting flags all over the globe.
What is absolutely critical for the retail investor to understand about this international expansion is the dual model they are deploying.
Dual model? What do you have?
In Europe, Chipotle owns and operates the stores themselves. It took them years to figure out the European consumer, but they were finally seeing high single-digit comp growth there as they aligned their European operations with the highly efficient North American standards.
So they took the pain of figuring it out themselves over there.
Yes, exactly. But for the Middle East, Asia, and Latin America, they are not doing that.
No.
No, for those regions, they're using a partner-operated franchise model. This is a massive strategic shift. It allows them to expand globally at an incredible pace without the massive capital expenditure, the logistical nightmares, and the sheer operational risk of trying to build out a corporate infrastructure in highly complex, unfamiliar foreign markets.
That makes a lot of sense. Let someone else deal with the headaches.
They let the local experts build and run the stores, and Chipotle simply collects a high-margin, royalty-driven revenue stream.
So you have a business that is currently dealing with some annoying domestic short-term margin squeezes, but underneath that noise, they're opening a highly profitable drive-through domestically every single day, and they are collecting fat, risk-free franchise checks globally.
That's the story in a nutshell.
Which brings us perfectly to the moment of truth. We have looked at the raw data, we have unpacked the complex story behind the margins, and we have analyzed the murky guidance for the future. It is time to deliver the Talk Ticker's actionable takeaways.
All right, based on the totality of this dense, incredibly nuanced earnings call, our definitive verdict on Chipotle, ticker symbol CMG, is a split decision.
A split decision.
Yes, we are short-term, neutral to bearish, but long-term, incredibly bullish.
Let's break that down carefully for the two different types of listeners we have tuning in right now. First, let's talk to the current holders. If you already own shares of CMG in your brokerage account, you bought it a year ago, maybe 5 years ago, what is the actionable play based on this new data?
Our advice is simple. Do not panic.
Do not panic.
Do not let the headlines about the flat EPS this quarter shake you out of your position. Do not panic over the weak +1% Q3 comp guidance.
Right.
Yes, we acknowledge that margins are currently getting squeezed by labor investments and beef inflation. Yes, the cyclospora shadow is an unfortunate, unfair reality that is going to hurt their Q3 foot traffic in the short term.
All true.
But the underlying unit economics of this business, the actual math of building a single restaurant and selling food out of it, are among the strongest in the history of the entire restaurant industry.
You have to look at the new store metrics they casually dropped into this call. They noted that their newly opened restaurants are generating an 80% productivity rate right out of the gate compared to their established, mature existing base.
Which is phenomenal.
And more importantly, they are generating a massive 60% year two cash-on-cash return.
That 60% cash-on-cash return metric is exactly fundamentally why you hold this stock for the next decade.
For the listener who doesn't spend their day looking at commercial real estate underwriting models, explain how anomalous a 60% return is. Break that down into plain English.
Think about it like buying a rental house.
Okay.
If you put $100,000 of your own cash down to buy a rental property, and after paying the mortgage, the taxes, and the maintenance, you walk away with $10,000 in pure profit at the end of the year, that is a 10% cash-on-cash return.
Right, which most real estate investors will be pretty happy with.
Yeah. Exactly. In the corporate restaurant franchising world, a 20% or maybe 25% cash-on-cash return is considered an absolute home run. It means your new restaurant pays for its own initial construction costs in about 4 or 5 years.
But Chipotle isn't doing 20%.
No, Chipotle's doing 60%.
That's absurd.
What that means in raw math is that if Chipotle spends $1 million in capital expenditure to build a brand new restaurant with a Chipotlane, by the time that restaurant hits its second year of operation, it is kicking off $600,000 in pure cash flow annually.
Wow.
The payback period on their initial capital investment is lightning fast, less than 2 years. When a company has a machine that can deploy capital at a 60% annual return, you do not worry about a 200 basis point margin squeeze in 1 quarter.
No, you let it ride.
You just want them opening as many of those stores as humanly possible, and they're opening 350 of them this year.
Plus, as a current holder, you have that newly authorized $1.3 billion stock buyback program acting as a massive safety net under the current share price.
It's a great cushion.
So, for the current holders, the verdict is a definitive: hold strong, let the compounding machine do its work. But what about potential buyers? What if someone is sitting on a pile of cash, looking at this post-earnings dip, and wondering if today is the day to start a new position in CMG?
For potential buyers, our short-term bearish verdict kicks in. We suggest waiting for the dust to settle.
Don't jump in yet.
Do not rush in today. The third quarter is going to be messy. The industry headwinds from the food safety scare are real. They are happening right now. And the margin squeeze will not fully resolve until that pricing to inflation gap finally closes in the fourth quarter.
Right.
You are highly likely to see a more attractive entry point, a much better valuation later in the fall as the broader market digests what will probably be a sluggish, uninspiring Q3 earnings report a few months from now. Keep your powder dry.
So what does this all mean for you, the listener, trying to build wealth? Think of this company right now like a magnificent piece of real estate that needs a little bit of cosmetic work.
Great analogy.
The Q2 margins look a bit messy on paper. Maybe the paint is peeling in the kitchen. The short-term curb appeal is suffering because of the media scare. But the foundation of the house, the throughput engine, the digital flywheel, the zero debt balance sheet, the unit economics, that foundation is absolutely bulletproof.
Completely bulletproof.
The math is screaming, bye, just maybe not this exact second, if you are trying to optimize your entry point.
Exactly. The true enduring value of CMG isn't found in a single quarter's margin compression. It's found in their unique, almost unparalleled ability to open a highly profitable new store nearly every single day of the year without cannibalizing their existing customer base.
Which is hard to do when you have that many stores.
It is. Management even noted a metric proving this. The net impact of opening these 350 new locations on their existing comparable sales is only a tiny 100 basis point drag.
That's nothing.
For a brand with this level of geographic density, that lack of cannibalization is staggering. It means there is still massive unmet demand for the product.
All right, that brings us to the close of this Talk Tickers deep dive. Let's do a rapid-fire recap so you can walk away with the narrative firmly in mind.
Let's do it.
Revenue is up a stellar 9.3%. Margins are momentarily squeezed down to 25.2% due to increased portion sizes, higher labor wages, beef inflation, and freight costs, which resulted in a totally flat earnings per share.
Yep.
However, the Heapy equipment package and the linebacker deployment are fundamentally transforming their back-of-house throughput during peak rushes. Q3 is going to be a bumpy, volatile ride due to the industry food safety headwinds and a tricky price hike, but the long-term unit growth story remains absolutely elite.
It is the classic Wall Street story of short-term noise masking long-term fundamental strength. The patient investor wins here.
Now, before we sign off, I promised you an unfiltered look at this company, and I want to leave you with one final forward-looking nugget.
Oh, this is a good one.
This was a tiny detail buried deep in the Q&A portion of this call, something most analysts completely glazed over, but it has massive, massive implications for the future. Management made a passing comment about their digital rewards program.
Right.
Currently, 90% of their digital orders are scanned for rewards. That makes perfect sense. You're already in the app. It's automatic. But only 20% of their physical in-store transactions are currently scanning for rewards.
When you really think about that number, it is staggering.
It's an 80% gap.
It means 80% of the people who physically walk into a store are anonymous, untracked buyers. They walk in, they pay with a credit card, and they leave without the company capturing a single piece of actionable data on their habits.
Right. But here is the kicker. In August, management announced they are piloting a frictionless automatic in-store reward system in select markets.
This is huge.
You swipe your credit card and the system automatically syncs to your profile. No QR codes, no phone scanning, no friction. So here's the provocative thought I want you to ponder as you watch the stock over the next year. If Chipotle can seamlessly convert that massive 80% gap of anonymous in-store buyers into tracked, loyal, personalized data points using this new frictionless tech, how much untouched recurring revenue is just sitting on the table waiting to be unlocked in 2027?
It changes the entire marketing paradigm. When you can market directly and personally to an engaged customer based on their specific ordering habits, your customer acquisition cost drops to functionally zero.
Wow.
That is a massive structural margin unlock waiting in the wings.
Something to keep in the back of your mind as you watch the headlines over the next few quarters. Thank you for joining us for this deep dive into Chipotle's Q2. Keep your portfolio sharp and your insights sharper. See you next time.